recognized.
Thank you, Mr. Chairman. Mr. Secretary, thank you for your patience and staying with us here. Since we've talked a lot today about market liquidity, let me bookend our discussion here today with that subject. The Center for Financial Stability has found that market liquidity has declined 46% since its peak in March of 2008, and a recent article in the Wall Street Journal provides this analysis. Talk to almost any banker, investor, or hedge fund manager today, and one topic is likely to dominate the conversation. It is the lack of liquidity in the markets and what this might mean for the world economy and their businesses. Market veterans say that they have never experienced conditions like it. Banks have become so reluctant to make markets that it has become hard to execute large trades, even in the vast foreign exchange and government bond markets, without moving prices. So I want to address my question to your skepticism that regulation has played a part in this liquidity issue. Have you heard from bankers, many of your former colleagues on Wall Street, and bankers that I've heard from as well, that they are less likely today to engage in market-making activities as a result of Volcker and other regulatory pressures?
Look, I have heard people say things, some of which are supported by fact and some of which are not.
But you,
what people say,
clearly as Secretary of Treasury, you have...
I talk to people all the time.
And they've given you that feedback.
Yeah. But
what is it that leads you to doubt their sincerity, or do you not?
I'm not doubting anyone's sincerity. I think people see the world the way they see it. Sometimes it's right and sometimes it's wrong. I think that, what you just cited at the end of the piece that you read, that people are saying they're having trouble moving blocks of bonds in any size they want without any movement of price. I think that that has something to do with market structure. You have different players in the market now. It may mean that to maintain liquidity, you have to do multiple transactions.
Understand, but
it's different from not being able to transact.
Understand, but would you acknowledge that when banks become reluctant to engage in market making, that impacts liquidity?
Yeah, I think there's different kinds of market making going on. If there's a lot of market making going on, and you can't roll back the clock. The fact that you have the emergence of, say, electronic trading and high-frequency trading, there's a lot of activity taking place in that space that isn't the traditional broker-dealer model.
Well, let me take one example, and this is the collateralized loan obligation marketplace. $350 billion of senior secured commercial industrial loans that provide financing for very dynamic job-producing companies, many of which are actually in my own district. Would you acknowledge that the Volcker rule has forced banks to take pretty significant losses in AAA and AA CLO paper?
But obviously, the Volcker rule is still taking effect. It hasn't. There are
already banks being forced to divest AAA and AA CLO paper.
I mean, the banks are going to have to not have proprietary investments, that they had in the past.
Right, but let me ask you.
That means that they're going to have to sell some assets.
Sir, do you know how many AAA or AA tranches of CLO notes defaulted over the last 20 years? The answer is zero. The Volcker rule is forcing banks to divest in very safe investments, and you've got to acknowledge that has a destabilizing impact on the financial stability of these institutions.
But I think you also have to acknowledge that the exposure to risk on proprietary investments was a significant
What risk
crisis.
is there with AAA or AA CLO notes that have never defaulted over 20 years and performed well during the financial crisis?
The objective of the Volcker rule was to reduce the level of risk exposure of firms by getting them out of proprietary investments. I think they will be better off when that's implemented, and I think the markets will adapt.
You don't dispute the fact that Volcker forces banks to divest of AAA paper that hasn't defaulted in 20 years.
With the exception of Treasuries, it is a pretty tight rule in terms of...
Let me conclude just real quick with one other point, and that is community banks. Community banks in my district, the bankers tell me that Dodd-Frank and the avalanche of compliance costs and red tape has really impacted their bottom line, and the numbers bear this out. The number of community banks, 10 billion or below, has shrunk from 7,700 in the second quarter of 2010 to only 6,300. Meanwhile, there's consolidation in the industry. So the big banks, the SIFI banks, are larger. And too big to fail is a bigger problem now because we don't have diversity and we don't have competition, as much competition in the system. Can you respond to that financial stability issue?
Look, I think the consolidation was going on before Wall Street reform was enacted, and I'm not sure that that consolidation is leading to the SIFIs taking over. It's mostly smaller banks combining, and it's an issue that we have a real shared interest in making sure communities have access to community banks.
And I'd encourage FSOC to look at consolidation, industry consolidation, as a problem because it is exacerbating too big to fail. Thank you. Yield back.